All right, let's start with something that sounds, well, completely backwards. What if I told you that the safest place you could possibly keep your money, your savings account, is actually the one place where it's absolutely guaranteed to lose value? It sounds nuts, I know, but stick with me because today we're going to unpack exactly why this is true, and more importantly, how a little shift in how you think about this stuff could totally change your financial future. Okay, let's get into it. So, let me ask you this, just straight up. What if the money you've worked so hard for, the money sitting in your account right now, is actually losing a tiny bit of its value every single day? And the crazy part is, you don't even have to do anything for it to happen. Now, this isn't some what-if scenario. For almost everyone just holding on to cash, this is what's really happening.
Okay, so the whole problem really starts with a basic misunderstanding of what money is. We all tend to think a shekel is a shekel, right? That its value is fixed, but it's not at all. A much better way to think about it is like a ruler that's shrinking, just a little bit all the time. Think about it. 1,000 shekels today buys you way less than it did 10 years ago, right? And you can bet it's going to buy even less 10 years from now. So what we really care about isn't the number printed on the money, it's what that money can actually get you. It's real-world buying power.
And that invisible force that's shrinking our ruler? Well, it has a name you've definitely heard a million times. Inflation. It sounds like this big, complicated economic thing, but honestly, all it means is that the price of stuff, coffee, gas, rent, is pretty much always creeping upwards. And if prices are going up, that's just another way of saying that the value, the purchasing power, of your cash is constantly going down.
So if we agree that just letting our money sit there is basically a slow-motion losing game, then what are we supposed to do? What's the alternative? Well, this leads us to a really, really important question. And to answer it, we have to understand the huge difference between two words people often mix up: investing and speculating.
Okay, let's get a really clear definition down for investment. An investment is when you put money into something today with a reasonable expectation that it will hold its value or, even better, grow over time. Now, those two words are the absolute key to this whole thing: reasonable expectation. Remember that.
And to make this crystal clear, let's take a trip to a casino. Imagine you walk up to a roulette wheel. You take a deep breath, and you slap all your cash down on black. Now, you're definitely hoping to make more money, right? But does that hope make it an investment?
This is where it gets interesting, because there are two sides to that exact same bet. For you, the player, your odds of winning are actually a little less than 50-50. Why? Because of those pesky green zero spots on the wheel. So mathematically, if you play long enough, you are expected to lose. That, my friends, is speculation. But what about the casino? For them, their probability of winning is just over 50%. And that tiny little edge, spread over thousands and thousands of bets, gives them that reasonable expectation of making a profit. For the casino, running that table is a stone-cold investment. See the difference? It all boils down to this one simple idea: a positive expected return. An investment is anything where the odds are tilted, even just a tiny bit in your favor. It's about playing a game where, on average, you're set up to win over the long haul.
All right, so now that we have this really sharp definition, let's circle all the way back to where we started: your savings account. Based on what we just learned, is just holding cash an investment? Does it have a positive expected return? Or is it something else?
And here it is. This is the big reveal. With inflation just chugging along at, say, 2% a year, your cash is pretty much guaranteed to lose 2% of its buying power every single year. That means it has a negative expected return. So if we're being honest and using our definition, keeping your savings in cash isn't an investment at all. It's a speculation where you are betting on a loss that's almost a sure thing.
Whoa. Okay, so that idea should make us completely rethink what the word risk even means. Most of us, when we hear risk, we immediately think of the stock market bouncing around like a yo-yo. But that's actually a really flawed and frankly dangerous way to look at it.
So let's try a new definition. The real risk isn't about those wiggly lines on a chart. The real risk is the chance that down the road, your money won't be enough to let you live the life you want. It's the risk of not being able to retire comfortably, or not being able to help out your family, or just not meeting your financial goals. That's the risk we should actually be worried about.
And this isn't just theory. Let's look at the actual numbers over the long term. Let's say you have 1,000,000 shekels today, and we fast forward 30 years. If you left it in cash with that 2% inflation, its buying power would shrink to about 550,000 shekels. Ouch. Okay, what if you put it in bonds that just matched inflation? You'd still have 1,000,000 shekels of buying power. You broke even. But what if you'd invested it in the stock market? Well, based on average historical returns, that same million could have grown to over 5.7 million shekels.
Just look at that difference. It is absolutely staggering. We're not talking about a small change here. This is more than a 10-fold difference in the outcome. That's not just numbers on a screen. That is literally the difference between a secure, comfortable future and one filled with financial stress.
So let me ask you that question one more time. What's the real risk here? Is it the bumpy ride of the market in the short term? The volatility? Or is it the very real possibility, the near certainty even, of ending up with just a tiny fraction of the money you'll need to actually fund your life?
Okay, so if we're on the same page that not investing is maybe the biggest risk of all, then what are the actual tools in the investor's toolbox? It sounds complex, but honestly, it all boils down to two basic ideas: loaning versus owning.
So let's talk about loaning first. This is what you're doing when you buy something called a bond, or agach, as we say in Hebrew. When you buy a bond, you're basically playing the role of the bank. You lend your money to a government or a big corporation, and they sign a legal contract promising to pay you back the full amount, plus some extra in interest.
Here's a super simple way to think about it. Imagine your favorite local coffee shop needs 100 shekels to buy a shiny new espresso machine. You give them the 100 and they give you a little piece of paper, an IOU, that says, "We promise to pay you back 104 shekels at the end of the year." That little note? That's basically a bond. It's just a formal IOU that's legally binding.
Okay, so that's loaning. The other side of the coin is owning. This is what you do when you buy a stock or a manayot. Here, you're not lending anyone anything. You are actually buying a tiny, tiny piece of the company itself. You become a part owner, you're a partner, and you get to share in all of its future success.
And right here is the fundamental trade-off between the two. When you're a lender holding a bond, your potential profit is capped. You know exactly what you're going to get: your original loan back plus interest. That's it. But as an owner holding a stock, sure, you could lose your investment, but your potential gain is, well, it's unlimited. If that company becomes the next big thing, the value of your tiny piece can grow and grow and grow. So if there's one thing you take away from all of this, let it be this: you cannot escape risk. It's impossible. Keeping your money in cash, as we've seen, is a risk. Buying bonds has risks. Buying stocks has risks. So the goal isn't to try and find some magic, risk-free hiding place for your money, because it doesn't exist. The real goal is to understand the risks you're taking and to make sure you're getting paid or compensated for taking them.
And so I want to leave you with one final question to really think about. Take a hard look at your own financial situation. Is the plan you have right now built on a foundation of actual investments, things with a positive expected return that are designed to grow? Or have you been, maybe without even realizing it, speculating with your future on a strategy that's almost guaranteed to lose value over time?